Hi, everybody. This is Peter Schiff. It is Tuesday, July 20th, 2010. Well, we continue to get weak economic data. It's surprising that the media continues to characterize the weak data as being unexpected. I don't understand how come they can't anticipate this at this point, especially when it comes to housing. That's what we got today, more weak housing data. And it has everybody speculating that when Ben Bernanke testifies tomorrow in front of the Senate, that he will signal that the Fed is going to ease monetary policy further in order to stimulate the economy and head off this potential double-dip recession. Now, it's hard to imagine how Fed policy can be any easier than it already is. After all, interest rates are at zero right now. Well, the idea is, at least reading in the Wall Street Journal, is, well, they could bring them to negative. Well, how are they going to do that? Are they going to put a minus sign and pay people to borrow money? No. The way the Fed writes it is they just need to raise inflation expectations. You see, if inflation is going to be 3% and you can borrow at zero, well, that's a negative 3% because when you pay back your loan, you're paying it back in money of diminished value, and in effect, you're being paid to take out the loan. As if this is going to stimulate the economy. It's going to create inflation. We'll debase our money, but it's not going to create economic growth. In fact, that inflation is going to stifle economic growth. Now, of course, the Wall Street Journal is a little bit concerned about the risks of this policy because they think we'll get too much of a good thing, as if a little bit of inflation is good, but a lot is bad. And the idea is that, well, what if we overshoot? What if we don't get 3% inflation? What if we get 5 or 6 or 7? Or the Fed can't put the inflation genie back in the bottle? Well, the reality is none of it is good. It's like they talk about, we'll just have a little inflation, like you're going to get a little bit pregnant. You're either pregnant or you're not. They're going to create inflation or they're not. Once they go down that road, there is no way to get that genie back in the bottle. And even if they can hold the inflation to a small amount, it is not going to do anything. We don't need more reckless borrowing in this country. Unfortunately, the only thing that's going to work is higher interest rates. See, they think that we have to keep following the same stimulus. The economy doesn't grow. We need lower rates, lower rates, lower rates. They don't realize that lower rates are at the heart of the problem because rates are too low. They're distorting the economy. We don't have enough savings. We don't have enough capital investment. We have too much consumer debt and government borrowing. We need to rein that in with higher interest rates. The fact that higher interest rates will expose the insolvency in our banking system and cause inflated asset prices to adjust back to realistic levels, that's something that we have to deal with, not paper over. I also read in the Financial Times that they thought that Ben Bernanke would go to Congress and assure the senators that the Fed has the tools at its exposure to fight simultaneously inflation and deflation. Well, how are they going to do that? First of all, their main tool is interest rates. They theoretically fight inflation by raising rates and deflation by lowering them. How are they going to raise them and lower them simultaneously? In fact, I wrote an article about that a few years ago. And I said that the Fed can't slay two dragons at once. If they tried, they would slay neither and be consumed by both. And if you take the phony definitions of inflation and deflation as rising prices and falling prices, we are actually going to have both. It just depends on which prices you're looking at. Asset prices, real estate, stocks ame, certainly bonds eventually, they're going to fall. But consumer goods prices, food, energy, clothing, and certainly, healthcare, education, these costs are always rising because of government subsidies. Those types of prices are going to be rising. How is the Fed going to stop consumer prices from rising and asset prices from falling at the same time? They're not. It just can't be done. But of course, this is the tightrope that Ben Bernanke is going to attempt to walk when he testifies. It'll be interesting to watch his testimony, and I will certainly be commenting on it myself. Another major news story, at least I thought it was major today, I didn't think it got much coverage, was China. China is now the world's largest consumer of energy in the world. It just surpassed the United States. Now, the United States held that title for 100 years. 100 years ago, we became the world's biggest consumer of energy, and we've been the world's biggest consumer of energy for the last 100 years until just now. Now, some people are going to say, well, China's a much bigger country, so they should consume more. They have a lot more people. Well, they've had a lot more people the entire last 100 years. So this is a sign that our economic dominance is waning and China's is rising. In fact, it was just recently that China surpassed the United States as having the world's largest automobile market. And now, of course, they have the world's biggest energy market. Much of that energy, of course, is driving all the automobiles that they now have. Now, what does this mean? Well, first of all, as the Chinese consume more energy, of course, they're going to produce more energy. But a lot of the extra consumption will be imported. And where's that going to come from? Well, that's going to come at the expense of Americans, because the oil that the Chinese consume is oil that Americans can no longer consume. We get outbid for it. And in fact, with our production falling based on a reduction in drilling offshore, thanks not only to BP but to the president's moratorium after the BP's disaster, we're producing less. China's consuming more. Prices are going to go up. Look at the oil chart. Oil's at $78 a barrel right now. I think it looks like a coiled spring. I really think the price is going to shoot up. And with the renewed weakness in the dollar that I expect to continue, that puts more upward pressure on the dollar price of oil. So all of this is very significant. Eventually, not only is China simply going to surpass us in automobiles and in energy consumption, but they're going to surpass us in GDP. I think they've already just passed Germany, or Japan rather. I think so. The United States is still a larger economy by GDP, but that's going to change. It's not going to change in 30 or 40 years like some people think. It'll change within the next 10 years. And it could be sooner than that. A lot of it depends on the pace with which the Chinese allow the RMB to appreciate. The sooner and the faster they allow their currency to appreciate, the quicker their GDP will surpass the United States. Now, when they can do that on a per capita basis, well, that I think is much further into the future. But certainly on a total basis, they can overtake the United States a lot sooner than what people think. One more thing I wanted to mention, call attention to my most recent commentary on the WWIII website about another world war. I thought about that commentary. I was a guest on NPR radio, I think about a week ago. And after my segment, I was listening to the next segment, and there was a discussion. There was a guest on there who was an economist. And the economist was saying that what we need to get out of this Great Recession is another big government spending program like the Second World War, because that's what got us out of the Great Depression, so we need something like that. And the host said, well, wait a minute, we got two wars right now. We got Afghanistan, we got Iraq. Why isn't that enough? Why isn't this war spending stimulating the economy? And his answer was, well, those wars aren't big enough, as if escalating the wars was somehow going to be good for the economy. And of course, I started to think about, this is a generally accepted idea that all this wartime spending, it got us out of the Depression. It didn't. It was when we stopped all that wartime spending that we got out of the Depression. Sure, the war created a lot of jobs, but the economy didn't get any benefit out of those jobs. We had 10 million men in Europe and Asia fighting a war. We had all our factories making bombs. Those factories couldn't make consumer goods. Consumer goods were actually rationed during the Second World War. I mean, there was a lot of sacrifice going on during the Second World War in the United States. People don't remember that. And, in today's dollars, the Second World War cost about $20 trillion. And 3/4 of that $20 trillion was paid for by selling bonds, war bonds. Guess who bought them? American citizens bought them all. So they had to buy those bonds instead of doing other things with their money. They couldn't spend it if they were buying government bonds. They couldn't make other investments. We don't even have any, we have no savings to pay for a peacetime budget. We're borrowing from the Japanese and the Chinese right now without the Second World War. Also, they raised taxes. The withholding tax, where you have income taxes coming out of your pay, that didn't even start until 1942. It was a victory tax. And it was a tax to finance the war. So part of the war was paid for with a tax hike. Is anyone talking about a tax hike to get us out of this recession? Not at all. And of course, when the war ended, we had to pay back that money. So we were deeply in debt. But the point of view, I'm trying to poke fun of that in my article. So in my article, I talk about the fact that, look, in a joking way, how can we have the benefits of a war to the economy without people having to die? After all, do we really want World War III? Do we really want all those people dying? And so my solution was that we have a fake war, that we just have war games, a pretend war, where we have all the benefits of wasting resources fighting a war without any casualties. And anyway, I thought it's very tongue-in-cheek, but you should check it out. It's on the WWIII website, WWIII.net. Anyway, take care, everybody. That's it for now.